Well, good morning, John. It's been another eventful week. We're recording this on Friday morning, and overnight the US markets have sold off a little bit. It seems like during the month of November, a lot of profit taking is coming off the table and the mood is souring a little bit. One of the more important elements has to have been a reporting season. I noticed that the Australian valuations have come back a little bit. So we started the month where the ASX was on a multiple of about 18.5. Following results, it's come back to about 18 times. John, does that give you more reassurance that we're seeing kind of reasonable value, and how do you interpret that?
Well, there's been limited number of surprises, Paul. I think some companies, much less than more, have surprised. So more companies have achieved what the market expected or underachieved. There's been very little surprise in terms of dividends. So that's not supporting the market. But the more important thing behind all this, which I guess the public and our clients don't see, is broker forecasts are being rapidly pulled back. Now, they're always optimistic when you start the year. Now we have the half year, and there's an adjustment in some parts of the economy, some parts of the market by 10%. So when we look at the PE you quoted, it's probably higher than we think until all these reassessments come through the market. So the ones which have been captured with a declining market also occurring, the market's now down 4% in the last 2 weeks. There's a lot of moving parts. I think we'll know more where the PE is probably in 4 weeks' time when we get all the results, all the dust is settled. There's some interviews done with management, and we get more clarity. But I think the point is taken that the market's pulling back. It's trying to bring down the PE, but it's work in progress, so to speak.
As you say, there are always so many different moving parts. A few themes, I guess, that are imposing themselves on markets. The one is Trump making new tariff announcements. I mean, virtually every day it's, we're going to do another 10% on China. We are going to impose 25% on Canada and Mexico, then a 10% tariff on the EU, and today's had a good meeting with Starmer from the UK. Every day it's throwing up more uncertainty. I don't know how much that factors into markets on a daily basis, or whether it's just noise that we have to deal with.
Well, I think there's too much of it now. I think you hit the ground running, which he has. I think he would be well advised to slow down. Okay, you've done your shake. You've done your big announcements, and now be a little bit more thoughtful, but that's not the type of president that he is. So it's a question of whether he's going to ease off a bit and be a bit more, thoughtful in his approach. But that might be a wish. It's interesting, though, there's two things which I'm watching, one less so, one more so. Bitcoin's come back dramatically since the inauguration by about 15%, which completely dismisses, at least in the short term, that Trump is positive for Bitcoin. And even though he's created more uncertainty, Bitcoin hasn't been a beneficiary. It could be that Bitcoin doesn't like uncertainty. And that would be interesting, given it's highly... And that would be... It's interesting. It may be justified because it's a highly speculative asset, and speculation is much more sustainable if it's based on something, and uncertainty creates difficulty for pricing anything. The other asset class is the bond market, and the 10-year bond in America has rallied in the last week quite strongly, relatively, 4.5% down to 4.3 last night. So as the risk of inflation has picked up with tariffs, and you'd expect bond yields to rise, the uncertainty caused by policy decision making and the withdrawal of money or flows into the equity market is going into the bond market, and it's doing what it normally does historically, as a hedge to the equity market. So we've got an interesting situation. Now, I watch the 10-year bond because that's your risk-free rate of return. and at 4.3%, that's highly supportive of the equity market, which should be giving returns far in excess of that. So let's continue to watch that and check in, Paul, each week, what's going on in the bond market and the Bitcoin market and I guess the gold market, and just see what all these markets are doing as decisions are being made by the American president.
Yeah, I must say, at the start of the year, I think we identified that the bond market was a risk to valuations, and that risk certainly has receded in time. Over the last couple of weeks as well, you mentioned Bitcoin. Bitcoin's come off. Gold has been relatively strong, although not overnight. Metals have been a little weaker. Oil has been quite strong in I guess because of Mideast tensions and possible negotiations around Ukraine. I've also been watching the US dollar. It keeps on getting higher and higher, with the Australian dollar now back below 63. Is that something that would tend to support the valuations on the ASX?
Well, historically it did, and recently it hasn't. So that's the problem.
Yeah.
The nexus between the Australian dollar and Australian dollar assets and the weakness in the Australian currency was broken long ago. And, overnight, as you say, the US dollar rose, Australian dollar fell. Iron ore prices are fairly stable, well above 100. And we've got BHP quite weak today in Rio, the iron ore companies, even though theoretically they're getting more income with a weaker Australian dollar. The market's focused on the effect on tariffs on China. I think it's completely overstated. We actually do have history here. When Trump last put tariffs on China, it had virtually no effect on their growth profile, and they redirected their exports to other markets, and they will do so again, and they will find trade routes through neighbours into the open world, and they'll be closer to closer to Europe, and they'll be closer to the BRICS. And I would have thought that's not in the interest of America, that they drive China closer to Europe and closer to the BRICS. So when rational decision-making occurs from the American president, time will tell. But I'll finish the answer on this point. There was a cabinet meeting this week, which was well televised. Elon Musk turned up in his cap again, but his message is now becoming consistent. America's budget is unsustainable. And he used the word, look, we could go bankrupt here. Now, that's an extreme statement, but America's budget is unsustainable. And how are they going to fix it? It's not going to be fixed by tariffs, and it's certainly not going to be fixed quickly. And they run the risk of inflation. And normally they'd run the risk that bond yields go up and the cost of debt to the American government goes up in unison. So it's an interesting watch at this point in time. Not a lot of it's logical.
No, but obviously the bond market is liking what they're hearing based on its performance. Let's bring it back home. In Australia, I think we discussed last week a relatively benign CPI monthly figure for January. The other data point that came out was relatively weak CapEx spending over the December quarter. Obviously, the politicians are full throttle in election mode. As we've mentioned, the betting sites are indicating that there's more likelihood of a hung parliament than not. Do you see specific or sectoral risks in that kind of scenario? We have to have an election by the 17th of May. I think it's more likely to be a month or two before that. What do you see as the key risks that investors should keep in mind?
Well, you put your finger on it. A hung or minority government with the government relying on the support of the Greens would be a serious issue for the markets. And as that comes more into focus and a possibility, then the markets are going to struggle, because We are in a pre-election situation, but policy initiatives are not significant. We're not seeing anything. We're seeing electioneering with some decisions made, particularly in Medicare and bulk billing. There's an example. Bailout of companies, which we talked about last week, some private companies. But policy, i.e. affordability of housing, an improved healthcare system, not only through GPs, but we're now seeing real issues developing in the New South Wales private hospital market in particular, and questions being asked there. Is aged care sustainable? What's being done on NDIS to bring its costs under control? Childcare costs. And then you say infrastructure or capital investment by businesses in decline in December. Well, I'd suggest to you in March it's going to be worse again, because no logical company, other than what it has to invest in to sustain its business, it's not going to take risk capital investment when it has no idea what the long-term policy settings for this country are. And we've got what I would call very poor political debate going on and decision-making, which is ad hoc and trying to buy votes. It's not a particularly good political short-term outlook for a whole lot of reasons. And if that drives market sentiment, there's no reason to get excited in Australia until this election is out of the way.
So the message is basically sit tight, continue to review your strategy, make sure it's appropriate, but filter out the noise and await more certainty.
Well, it's not a bad time to, accumulate income. I mean, there's still income available, and if there is a dislocation in the markets, and we're seeing, as I said earlier, the bond yields are rallying in America, which suggests that corporate debt and some first mortgage debt, the yields there are appropriate. There's quite a good margin there, but be careful, and I think that's where we come into play. Also in the election, I should just say this, I mean, there is a lot of skullduggery going on. We're seeing comments about the opposition leader this week, and I don't want to get political, but there's a whole lot of commentary regarding the GFC and so-called bank bailouts. And I'm amazed that the press has not actually Googled the GFC and banking bailouts and seen that there was no bank bailout in Australia in January 2009. In fact, there was no bank bailout, so to speak, in 2008. There were support mechanisms, but we didn't have a TARP, i.e. we didn't inject billions of dollars into bank balance sheets in capital, government capital. The RBA did what it had to do in terms of supporting liabilities or underwriting liabilities. The government underwrote deposits. But that all started in September 2008 with the Irish government after Lehman Brothers went broke. And the TARP decision by America was mid-October 2008. Now, I'm not here to support Mr. Dutton, but I don't think buying shares in January 2009, and my recollection of bank shares were going up and down 10% in a day, most days. And it was a great opportunity to buy banks, good opportunity to buy the whole market. Because in March 2009, subsequent to that, as we know, the G20 got together and fiscal policy was turned on at a great rate and quantitative easing was turned on at a great rate to fund it. The commentary coming out of the Labor Party and attacking, the opposition leader with a completely false recollection of the facts which happened in 2008 with no checking mechanism by the media is extraordinary. And some of the statements I think are so bad, it will justify a lot of people in saying, I'm sick of this, I'm sick of these two parties. We're in an election campaign, can we talk about the future? Not talk about something which happened 16 years ago with a recollection which is totally wrong. So both parties better pull their, I don't want to sound like Jackie Lambie, both parties better pull their finger out and start talking about policy to get Australia moving and growing and get the cost of living down and helping Australia go into a growth cycle. Without that, I go back to the point, why would business sit there here and invest when they have no idea what the policy is or how the makeup of the next parliament is going to look?
Very, very interesting point, John. It reminds me that it was one of your big calls in the aftermath of the 2008 2009 period that you put clients heavily into bank hybrids, which were trading at magnificent
Yep.
discounts, and we did very, very well out of that.
Yeah.
Bank hybrids today are no longer really a feasible sector for investment. You've mentioned so often that it's time to bulk up income producing assets. Where do you look?
Well, you don't have to go aggressively into low rated or non rated paper with obscure fund managers. There's a lot of good fund managers around who are active in corporate debt, and we have them on board with Torica and our credit team inside Client. And also corporate debt and first mortgages. Again, if you don't go aggressively, there's nice yield there. Now, it's an open market. I think there's going to be potholes where, some groups and fund managers are aggressively lending to that sector more to push money out the door than to think about the logic of what they're doing. That's not the way to invest in debt. So we're going to be a lot more selective, a lot more disciplined, and not chase excessive yields, but get good returns at a nice premium to the yield on bonds, at a nice premium to the yield on term deposits, at a nice premium to the yield on the stock market. So I think that market's there, and you can generate reasonable return. And what are we trying to do? We're not trying to knock the lights out. We're trying to cover inflation, which, as you said earlier, 2.5% to 3%. If you can get 6, 7, 8% and not take excessive risk, that's not a bad place to be.
Yeah, I agree. John, we've run out of time. Thank you so much. That was really interesting. And to our viewers out there, have a great weekend, and we'll see you next week.
See ya.